on venture capital, which is a very, very interesting panel because here we have some very distinguished speakers discussing this today. So without further ado, I am going to welcome on stage our very, very distinguished panelists. We begin with Ms. Neha Grover, Regional Lead, South Asia Funds Group, IFC. Please put your hands together to welcome our panelists. Mr. Tarun Davda, Managing Director, Z47. Thank you. Mr. Ranjith Menon, Partner and Managing Director, Chiratae Ventures. Mr. KG Subramanian, Managing Director and CFO, Nexus Venture Partners. Mr. Vinod Murali, Managing Partner and Co-Founder, Alteria Capital. And this panel will be moderated by Mr. Hari Krishnan, Advisor, Venture Intelligence. Over to you.
Thanks, Namrata. All of you. The morning session was quite exciting. We're looking forward to the VC panel to put them again on a spot. I think Arun ended with, there was no AI. I think we will start with AI soon. And I have my favorite topic of the day, which is quick commerce. So we'll see how our friends are looking at quick commerce as well. I think all of us here have invested in quick commerce. So some take on that would be really something that I'm looking forward to. So as we begin, maybe I'll start with each of us, starting with Vinod here. If you could sort of introduce Alteria, I mean, each of the investors here, introduce your firm, introduce the current sort of outlook on investments broadly, and what are the key things that you're looking for at this point in time as we close the calendar year as well. Go ahead, Vinod.
Thanks for that. Good to be here. And it's always tricky when we have to shepherd the audience into the room. So I'm Vinod Murali. Alteria is a venture debt fund. They keep saying it's an oxymoronic term, but it seems to be working reasonably fine. So we provide structured debt to startups. And the idea is to give them, along with the equity they raise, a complement of debt as well to use for different purposes. Could be working capital, could be expansion, acquisitions, brand building, a host of reasons. So we've totally deployed about 8,000 crores. So it's been a very interesting journey to get here. We have more than 200 portfolio companies. We focus largely on domestic consumption. So consumer brands, e-commerce, financial services, climate to some extent. Talked about quick commerce. We're one of the few people who funded both Zepto and Dunzo and saw the journeys in some sense. And a lot of such stories as we go along. So great to be here.
Good afternoon, everyone. This is KG Subramanian from Nexus Venture Partners. Nexus has been focusing on India and US and a pure play venture capital investors. We've been in operations for about 19 years now and built companies across these two jurisdictions. Focused on software, AI, digital India, consumer, fintech. We've been specifically focusing on Indo-US corridor. Earlier software companies founded in India, and we've helped them go overseas. And now we are also seeing a reverse kind of a situation where founders in the US want to set up companies and leverage things in India. Very happy to be here and amongst this distinguished panel. Thank you.
Hello. Hi, everyone. My name is Ranjith Menon. I'm a partner at Chiratae Ventures. We are India's, hopefully, largest homegrown venture capital fund. We manage about $1.3 billion. We've been investing in India since 2006. We invested in across about 130 odd companies, Myntra, Flipkart, Lenskart, FirstCry, and a bunch of these companies that have gone on to become really big. Very lucky to have backed some of them very, very early. We tend to focus across consumption, across AI and software, healthcare, and fintech. These are four areas that we tend to focus on. Largely looking for people who are building technology and technology-enabled services, because that's a very fundamental to our investment thesis, that technology can do a lot of good. And we're currently investing out of our Fund 5 and looking to do exciting stuff.
Hi everyone, this is Tarun Davda from Z47. Some of you may not know the new name, but we used to be called Matrix Partners India until very recently. We just kind of rebranded. We're an early stage venture capital firm, invest from seed to Series B, typically starting with a couple of million and have the capability to go all the way up to 25, 30 million in a company over time. In terms of sectors, I would say we look at broadly 3 or 4 sectors. First one is consumer and consumer tech. Second one is fintech and financial services. Third one is B2B and sort of export marketplaces. These tend to be more domestic consumption driven. And then we also look at what we call our new emerging sectors like software, AI, EV, semiconductors, so on and so forth. So it's a good mix of both sort of compounding and domestic plays and some sort of innovation and global plays as well. So that's why we play and looking forward to the discussion today.
Hi everyone, I'm Neha Grover. Thanks to Venture Intelligence for having me here. I lead the private equity funds business for IFC. Very quick introduction to IFC. We are the private investing arm of the World Bank Group. We deploy about $60 billion annually globally across emerging markets. India is one of our largest single country exposure across the world. On the private equity and VC side, we've got about, on the PE side, we've got about 58 funds and co-investments. On the VC side, we've got about 20 odd direct positions, about 10 odd funds in the portfolio. So we invest, 80% of our business is debt, 20% is equity. Of that, about 40% is in equity through funds and VC. So it's a pretty big portion of our equity business. We deploy and commit to about, last year was about $1 billion or so in India across funds and venture capital in India.
Thanks, Neha. I'm going to stay with you. Since you've been looking at both VC and PE, I have 2 questions. How are you seeing the evolution of VC funds in the last 2-3 years? And on the PE side, how do you contrast the performance of PE and VC and between the two as well, if you could help with?
Sure. So I think the market across PE and VC, I'll probably talk about it at a 30,000 feet level and then drill down to VC versus PE. But the market has matured, right? Especially the PE market, given that we saw the first Leo fund managers coming in the mid 2000s, and we've seen about at least 3 to 4 fund cycles. People who've been here, even on the VC side, but largely on the PE side for about 3-4 fund cycles. There are private equity funds, but fewer VC funds who've been around for so long. But there are funds who've seen 3-4 fund cycles, and we've got a couple of them right here next to us, where KGS, you mentioned.
In fact, all of us here, I think, right? Like all the investors have seen
years.
at least.
But in different avatars, I think Alteria in a different avatar, you were in a different avatar. But yeah, so I think experience-wise, we have enough on the ground. There are teams, there are people who've been in this market for over 20 years. The market has matured. We are seeing one of the issues that the market had seen or the Indian industry used to face from global LPs was the fact that, hey, we've not seen any exits. That again, in the last 5-6 years, we've seen that change. One of the issues, and I can contrast PE and VC over here, PE, definitely we've seen a lot more exits, VC as well, but I think the ecosystem is still maturing. We are seeing now a lot more VC companies maturing, raising Series B plus C, D capital, but that's still a smaller proportion as a percentage of the overall pie that money has gone into the VC funds. So that's one difference that I can see between VC and PE, where DPIs for PE funds are respectable across a wider set of sample. But on VC funds, we still see DPI at reasonable levels only in a smaller portion. And it's because I think of the market maturity. But we are seeing the focus on DPI, the focus on exits improving, secondaries are increasing, liquidity is increasing, so absolutely seeing that. The other sort of challenge in India has always been valuations, where people say, hey, and that we saw in the mid 2000s in the on the PE side where there was a lot of money chasing a lot fewer deals. I think that again we are seeing a lot more discipline, and the discipline is not just with PE but also with VC, where we are seeing a lot more discipline, a lot more experience being baked into when you're sort of bidding for deals. We are seeing a lot more collaboration, right? Where people were earlier just competing and therefore outbidding themselves. We are now seeing that changing, and where people are saying, okay, let's maybe construct a slightly larger round and work together rather than competing with each other and spoiling it for everybody, and then returns as an industry will not be great. So that's the sort of big change that again we're seeing on. And the third very important piece is sectors, right? I think on the PE side, there are 4 sectors where 80% of the capital goes. On the VC side, again, large part of the capital goes in some core sectors. However, everybody's skinning the cat in different ways. So within those sectors, if I talk to each of the panelists, I'm sure they're looking at every sector very differently because their nuances are different. They're looking at some other sub-segment. How they want to play that is a little bit different. The experience that they bring to the table and the kind of promoters they want to back in each of those sectors will be very different, whether it's consumer, financial services, tech, or sort of healthcare, pharma, etc. So I think that again only comes with maturity of the market, of the experience, which I think we are seeing. So that's a great sign, because when LPs come and ask me as well, and we literally meet every LP who comes to India and they want to know, okay, how do we distinguish? And so there is no shortcut to that. You have to go into depth. You have to sort of understand the thesis, and then see whether the thesis matches with what your strategy is and who do you want to back. Because today there are like 1,800 funds registered, AIFs registered. We're not counting the international funds who have not come to India yet. But there are 1,800 AIFs registered across different segments, and many of them have a lot of differences, which is good as an LP.
Absolutely. May I ask how many funds do you have exposure in India? Is that number public or disclosable?
No, we can. So if I look at the overall number of funds, it will be close to 100 in India alone. That will be sliced between, so the largest bucket will be private equity, which would be close to 50. VC would be about 15 to 20. Active relationships will be fewer. And then we have about 15 to 20 funds, maybe a little bit more of sector funds, which we've done a lot of traditionally, but we've stayed away in the last decade. We've now sort of revisited those sector funds again. But yeah, so about close to 100.
Thank you. Now, looking at all the 3 VCs together, Tarun, Ranjith, and KGS, you can take a shot at it. So each of you, what's on top of your mind today, number one? And is India also getting more polarized between, let's say, the US's AI and rest of it? India maybe AI, Quickcom, and rest of it, and the rest of it is pretty small these days. Is that so? What's your take, each of you?
Yeah, maybe I can start. I think Neha said this. Finally, VCs have started talking liquidity, so that is top of mind. I think we all have been in business between 15 to 20 years. Finally, it looks like VC as an asset class has reached a point where one can even talk DPI. So far, it's always been, here are my mocks, here are my TVPIs, and I think for the longest time there was no conversion of that into actually cash distributed. And I'll maybe just spend a quick 30 seconds on that theme. LPs, have been asking us for the last 10 years, saying that, listen, India is a great market, but, your entrepreneurs are very high quality, your companies look really exciting, but why is there no IPOs? Why is there no cash? And, our response to all them has always been, and partly because we're always selling the India story, but our response to them has always been that, listen, the lack of IPOs is not the problem, it's a symptom of the problem. And the real problem is that our markets are not deep enough. And I think as the market deepened significantly post-COVID, companies got to scale faster, they're growing more of a higher base now. Companies are more capital efficient today than they used to be 5 years ago. Now, naturally, the IPOs have shown up, right? And I think the floodgates have opened. India is now probably the most buoyant venture IPO market in the world. I expect that will continue for the next decade or two. And so finally, I think hopefully the liquidity question, while it's still early, I think that is top of mind for everybody. We all have a lot of funds where there's a lot of companies. The other joke is, she was talking about secondaries, and somebody was telling me, hey, have you thought of a continuation fund? And I said, what do you think all the VCs have been running for the last 25 years? They just keep continuing, right? They don't end. I think that's just one thing. The second thing I would say is on the topic of just themes and sectors, I think India is unique in the context where if I was a VC in the US or in China, literally the only thing that I can invest in is in AI. There's no next social media company, there's no next e-commerce company, there's no next whatever B2B marketplace over there.
Why is it so? Is it the mature market, problems are
just very,
solved?
very mature. A lot of the themes that had to play out have played out. All the money is only reserved for AI. Entrepreneurs want to build only in AI. So it's a confluence of everything. And so it's really, really hard because by definition, you're investing in things where these are at the cutting edge, market sizes are known, business models are known. Yes, there's a lot of growth, but you don't know how much of the revenue will sustain, all that stuff. I think India actually, even today, offers a fantastic balance where I think you can keep investing in compounding plays, what I call compounding plays, right? So even within the consumer space, India is so underpenetrated on brands that you pick any category and you can still build a 500 to 1,000 crore top line company within 5 years, right? If you do a good job. And you can take that company public. Take financial services. We are so underpenetrated on credit. You can keep, basically just doing rinse and repeat, and you will keep finding more opportunities because again, it's a very vast market. So you just go, sector by sector. You can keep investing in what you've been investing in, and hopefully be sharper and better at it for the next decade, and you can make returns. You may not make the 50 baggers, but you will make a consistent 5, 10, 15 bagger doing that as an early stage VC. But because our innovation cycles and the gap between us and the US and us in China is reduced, we can also play the EV theme, we can also play the semiconductor theme, we can also play the AI theme. And while these are still nascent, I do expect that these will also mature fairly rapidly over time. So I think India is one of the unique markets today where you can just keep doing both. And you get your benchmark returns, playing the compounding plays is what we call them, while playing for the alpha and the outlier kind of plays with the innovation. So I think those are the two things top of mind for us.
Yeah, from our side, again, just echoing what Tarun is saying, DPI is super critical, right? We've been investing for the last 18 years or so, right?
I can see Neha smiling.
Right? Right? I'll tell you the difference. In our fund, our Monday meetings start with exits. We don't discuss investments beginning. We start the conversation with, okay, what's happening on the exit side? That's how much the shift has happened. So really, and we've put together a separate team that is just focused on, creating exit opportunities, right? I think that's an investment that we've made because, what we've realized is, like Tarun was saying, the investment folks get stuck to the companies, right? And they think, okay, the turn is going to come over the next Monday, it's going to turn, next Monday, it's going to turn, right? And we have a separate team who says, Ranjith, I think good time to exit right now, right? It's showing the mirror in some form. So I think we've made some of those changes because we really think that is, important, absolutely important, and it's top of the mind for us from an exit standpoint. And some of this has been working. We have a long way to go, but for the 1.3 that we've raised, we've returned close to $1 billion back. Okay, but still, nowhere close to what we should actually be doing. So I think there is significant effort from our side and absolute top of mind from a divestment standpoint. On the investment side, I think India, is still a very, very strong consumption story. But we don't have enough brands, and this is across categories, right? Whether you take fashion, whether you take entertainment, whether you take healthcare. You would think healthcare is not, is very difficult to build, but 70% of healthcare spends are out of pocket. So it is really a consumer kind of a story from that standpoint. So I think that is absolutely open in terms of, how we think about this. The other one is AI. Globally, there is significant interest, and I think that's a story that everybody is talking about. And like Tarun was saying, we're seeing the gap between the companies that we're seeing in India and in the US. closing significantly. I mean, even 5-6 years back, if you find a company in India, there will already be 10 companies in the US. 5 of them that have raised significant amount of capital. That gap has considerably, changed. The last big thing, I think, big theme that we are fairly interested in is around deep tech. Now we've been very opportunistic about deep tech from an investment standpoint in the last 15 years or so. I mean, we've done something in medical devices, robotics, and so on and so forth. But I think from an overall ecosystem perspective, there are certain areas within deep tech which we think are reaching a certain stage of maturity space, for example, right? Because there is significant interest from the government in some of these sectors, which are very, very strong tailwinds, which can be leveraged over the next 5-10 years to build companies that are very, very significant from an India standpoint. So I think that's one area that we are, investing in terms of building capability and understanding and so on and so forth.
KGS?
Yeah, maybe I think, both Tarun and Ranjith have already covered most of the, on the sector and liquidity. I think right from Neha onwards, we've been talking about. So, for Nexus, if you really look at, we are kind of sector agnostic that way from investing, though I mentioned 3-4 sectors what we focus on. So to that extent, what we have been, fortunate to work with some great founders, in India and in the US. So our focus has always been on identifying the right founder. Most of the time, we have seen that the founders were doing something when we started, and then they ended up with something else. So our focus is not much on the sector per se, I would say, but it's more on the founder and the quality of, co-founders and others who are coming together to do things. And on the AI, I would think that, AI is, it's like the old technology kind of sector, right? It's not that just one company will eat up everything. Because there are so much of, specialization happens even in AI. In our portfolio, we have about 20-25 companies in AI. I mean, they've been there for some time as well. Some of them are, almost like 10-year-old. Doing specific, targeted, segments, say for example, on customer experience through voice, or data security or website security through your identifying or profiling the user. And many such use cases we are seeing on AI. So again, AI, I think the challenge in India would be basically the organized way of data in India is going to be a little bit difficult. It's like our weather forecasting system in India versus US or India versus any other country, right? Because we don't have the data in an organized manner, because we get a lot of rain, but we don't have the data here. So is on the AI, but I would think we will definitely catch up on that aspect as well.
Thank you. So to summarize, we are seeing it's not polarizing just to AI and Quickcom and rest of it. It's like Tarun said, a lot of compounders, and then there is alpha. And within that alpha, like Ranjith said, it's not just AI, there is deep tech and a lot of subsegments within deep tech as well. And KGS is saying, we are founder first, it's okay, sectors come later, right? That's the theme I'm carrying. So flip the question, KGS, you were speaking about use cases, voice AI, customer profiling, etc., etc. These are AI use cases, how your companies are using AI. They're AI companies. I want to flip the question to your firms to understand how are you using AI as a firm? One. Number two, how are your non-AI portfolio companies using AI? Are there any interesting examples of AI being used in your day-to-day business, day-to-day life? Maybe one example, I mean, I just updated my profile on LinkedIn as stealth mode, and I get 2 emails from the same fund, 2 different people asking, hey, Harry, can we catch up for a coffee or a call, right? Like, so to discover companies, to discover founders is one use case I just sort of experienced firsthand, but would love to know, Tarun, starting with you maybe again.
I think it's a great question, by the way, and I think probably all of us are not doing as much as we ought to be doing, but I think we all started. I would say one is just basic stuff. I've just stopped taking meeting notes. All of us have used Granola and other tools. It's actually amazing how good these are. I think they can definitely take better notes than human beings can.
Is it even for offline meetings?
It's even for offline meetings. We
Okay.
could actually turn it on now and it will summarize the entire panel better than any of us can individually.
Can you spell that app for me, please?
It's called
Granola.
Granola. I'm sure everybody,
Thank you.
a lot of people use it. But it's not just that. There's many others. And anyway, so and even very complex topics, it can actually summarize really well. We do that. We've got the stealth mode stuff is something that we used to do scrapers earlier. Today, I think it's more AI driven. We have a tool internally where any lookalike of a particular founder archetype, you spoke about how, most early VCs there's no business to underwrite. And like he said, ideas change. So all of us are really looking at backing founders that meet a particular pattern that we think has worked for us. We've tried to codify that we've backed 150 entrepreneurs in the last 15 years. We're trying to codify which ones have worked, which ones haven't worked, where have they come from, what have their past lives been like, what is our
Can you
internal
spill some
read of
beans
those.
here?
And then, and we're trying to identify potentially other people that may have the same attributes and a similar background and similar experience.
Right.
And
One complaint against the VC ecosystem generally has been, you guys fund only if I'm from an IIT or an IIM, etc.
Actually, that's not true. I know that's the narrative.
Exactly.
And, that's probably.
So can you help us understand better
I
what
haven't
you're...
done the math, but I can tell you there's probably at least 30% of founders we have backed that have never been to an IIT, IIM, ISB, Harvard, Wharton, Stanford. It's like it just doesn't happen. So I know that's the narrative because some of those tend to get more of the news and the media coverage, but that's not true.
Anything insightful that's coming from the pattern matching, number one. Number two, do you use AI for the pattern matching as well? Founder persona pattern matching, or could you use?
So we haven't gotten there yet, but there is an internal project running in our firm. It's called TRI, which is the Rational Investor. We actually want an AI agent to be sitting in all our IC meetings. That is making sure that the team has asked the right questions. That is making sure that we are evaluating the response that the founding team has given us without any biases. That's actually telling us, how best to kind of structure this investment. Like I said, it's a WIP. We haven't built it out fully, but we're running small pilots already within the firm. We use it a lot for like anyone. We have an app internally. If anyone has met anybody, who met, when they last met, what's our next step? Are there any follow-ups from that? Is this somebody that we want to spend more time with? Do we want to bake this person? Generally, and I think again all firms do this. We try to build relationship with founders. In some cases, many years before we want to fund them. And oftentimes, even though the person, our internal joke is, we know we want to fund this person when they start up, even before they know that they are starting up themselves. So we try to do all the work in advance because he said it's about backing people. A lot of that stuff happens with just deeper engagement. So there's a whole lot of different projects running at any point in time in the firm.
Any interesting example that comes to mind? Any non-AI portfolio company using AI in...
So actually two examples. I told you about financial services. We actually have, and I don't want to name the company, but we actually have a fairly early stage, completely offline, branch-led model lending business. We actually hired a AI developer in our team recently, and he works across our portfolio companies. And he said, well, this team, which is completely offline, branch-led, sitting in some, small city in South India, is actually using more AI in their underwriting function than I've seen most of the fintechs use, right? And so there are a lot of people. You don't need to be an AI company to use AI. You can actually just leverage what is out there and actually improve it. We have another fashion company. It builds ethnic wear for women. They've been on a really strong growth trajectory. They use AI to predict designs, fabrics, styles that women will like. They put it up on the website based on, again, where your cursor is, how many times do you click, do you look at the product detail page, do you add to cart but then not check out. It uses like tens of thousands of data points and is constantly refining the engine every day. And then we have something internally called, is this a first batch or is this a bestseller? Every single month, the percentage of bestsellers of what we produce keeps going up, which basically is evidence that the AI is working. Because we actually don't have any human designing anything. It's all designed by AI. It's put up on the website. We actually don't have even a model that's wearing it, but again, all that is AI driven. It's put up there, and every day customers tell us by clicking on certain products, adding to cart, expanding the product detail page, zooming into the design to see, and all of that tells us whether this is likely to be a bestseller. And so there's just so many different examples across the portfolio.
Thank you, Ranjith.
You know, I wanted to say we have a unique system inside that can identify founders, but then they're already building one, and I'm sure he's doing something, right? But yeah, I mean, so sourcing is, we are an early stage fund, right? So sourcing is super critical. So whether it's stealth, whether you're thinking of starting up, we are trying to see how we can reach you and you know, build a relationship with you. I think there's significant investment towards that end. That objective that at least Chiratae is investing in. The second one is really in terms of portfolio management. We've got 130 odd portfolio companies, and how do we kind of look at what is happening in these companies? MIS has hit the system. There's a portfolio finance team who looks at what's happening in these companies. And then more importantly, within sectors, there is a lot of learning that you can see, okay, some companies are doing some things better, and how do we learn from that we can pass on? So there is systems that we are building towards that objective. You know, from an IC standpoint, we're also building something saying that who said yes to and no to what, and you know, how and what those companies, whether we said yes or no, and for the ones that we've said no, how, you know, what's happened to them, and how we can reflect on what we did as individuals in terms of voting. Did we say yes, no? I mean, there is some you know, process that we are trying to build for that piece. And the last one is around, you know, LPs. I mean, there is so much of information that goes to them. There is some investment that we're making towards in terms of how we can make it easier for them to access, not just at the fund level, but a little bit more underlying data in terms of what the companies are trying to do. So there is, you know, investments for building some of these tools that we are doing by ourselves. I mean, as in we are getting somebody else to build it, the third-party platforms, and so on and so forth. So there is a lot of initiatives. I think one of the hardest thing is, you know, one thing is to build all of this, right? Getting the people to use it is also something, is a strong initiative that we're doing internally, making sure that people also kind of adopt these and make use of this so that we can really reflect back on what is being done and how we can better.
Interesting. Very nice examples of how you're using AI between both the funds. Yes.
So, you know, I am actually, I have to be careful what I'm talking about here. I don't know how many AIs are, you know, hearing this and then analyzing what we are saying. But having said that, I think, you know, this is, again, I don't think this is really new, right? Because I heard many years back, you know, Walmart, for example, their in-store cameras actually read the facial expression of the customers when they look at the particular dress or cloth or whatever, and then the price, and that reaction when they see the price and, you know, how they feel, and then put it back. They actually see and understand whether the customers are liking the price and the product, and, you know, what the matching, etc. Right? So this has been there for, you know, so many years. If you really look at it in various ways, but I think we are calling this as AI today. So at least, you know, our firm or my thinking is basically that this comes with a lot of risk, because my hat on the risk also wakes up when, you know, people are casually or generally want to use AI on everything what they are doing, because, you know, I get really, you know, a little discomfort, you know, when a Zoom meeting is happening when AI is on. Because you're discussing so many things, including compliance, regulatory, and structure discussions, etc. Right? They are a little gray, and you don't want all of this to be because you can't take this out of context and say, oh, this is what it is. You know, this is what he said, or this is what it is. You know, applicable, because that's not the right this thing. So this with that, I would say but there is still a lot of low-hanging fruits available for AI in a company like ours, because we are doing volumes of documents, reading, understanding, analyzing, summarizing. So there's lots of you know, things which we are doing at that level. But I would say, yeah, it should go step by step, though the world is moving faster. But on this front, I would say should be cautious and do step by step.
Yeah, ours is a slightly different perspective because we are a very high velocity shop. So we typically end up doing 50, 60, 70 deals a year. And there are repeat companies, of course, but we have a portfolio of more than 200 companies. And we have a few hundred investors. So one of the things that, as a preface to this, is venture debt has been more accessible for domestic investors. There's a very predictable distribution, which means more family offices have participated, as well as some institutions, including IFC. But what I'm getting to is when there is a high, when there's a lot of data on both sides, and there's a lot of velocity, there's a lot of information coming through, that's where AI can be useful. And some of this is theory, right? So the reality is, of course, we use for some basic aspects, just conversation quality improvement, just understanding more from, different sourcing is an important area, even LP management. So a lot of things are easier. We have our own bots, and summarization becomes easier. Ensuring action points are actually acted upon, and there's a follow-up. All of those can be done fairly easily now. And some of this has to be proprietary because there's a lot of sensitivity involved. Like KG has said, some of the conversations are very sensitive. The other thing that we, I think somebody else mentioned it also, is we get data monthly, we get payments monthly, and we have a lot of this data and payments coming through. So putting all of this together in a form and shape, which is, we rate our companies monthly. So it's a very, very high level of rigor, and which is kind of what results in low losses at the end of the day. So we've tried to improve the process quality. Can we use some of that? We've tried, but my answer also is it's not been as effective as one would have thought. So it's not something you can buy off the shelf and just do that because it's very customized. But we have some interesting companies that we fund otherwise, and they are helping us to build some of these internally. The last thing I'd say is we did experiment a little bit on just decisioning. And, for example, different ICs, we give different levels of input and see what is the answer, and across companies, across sectors. And we did this more to experiment to when do we get replaced, right, in some sense, right? Thankfully, not yet. So I think that there are, of course, there's a lot more that needs to be covered there. Getting to a 70-80% level of efficacy on these decisioning happens very quickly. Then is the last 20%, which sometimes is the make or break, when a lot of these decisions are not easy. And we're trying to build on our own data because while we've backed about 230 companies, we've got maybe a few thousand companies, a couple of thousand companies where we've done a lot of work on. And then when we've not done a deal plus done a deal, what is the decisioning? And we don't have all the data naturally today, but we're building the reservoir of information so that from an Alteria perspective, 5 years out, 2 years out, whatever the time frame is, can we have our own equivalent of a rating mechanism, right? External rating mechanism, which we do internally, but how does it translate to S&P or somebody else? That needs multi-cycle. It's a decadal journey. You can't do that with 2 years of data or 4 years of data. You need 10 years of data. You need a lot of color within the data. It's not just few data points for one company. It's hundreds of data points over time for hundreds of companies. And hopefully you get the right patterns out of that. And correlate that to actual losses, successes. So it's a very interesting mesh of information. I think the real value is, the information is there. Can it translate to something which can be usable? And hence it's still in the realm of theory. We've tried a few things. We're learning, I would say.
Absolutely. Very interesting to see in all areas like sourcing to portfolio management. IC member feedback loop. I think that's a new thing for me to learn. LP communication, all of this, right? Like very, very interesting. One use case I've heard from another fund is for governance, right? Like the monthly data stream that's available. Thanks to GST, all the monthly revenues are available. So comparing the monthly revenues with the reported MIS revenues is something that I'm hearing on the governance front. A couple of years back, we know a lot of examples of misgovernance, reported revenues not being actual revenues, and so on and so forth. Excellent to see this. So coming back to you, Vinod, on the venture debt side, what are some of the things that you're excited about? And at the same time, what are your top concerns as you look at opportunities?
So one is, I've been doing this for about 17 years now. The first few years are more about education. So what is the product, when it is relevant to somebody, including, I would say, investors, equity investors, as well as founders. So it's meant to play a role, and it doesn't play all roles. it's not meant to save companies necessarily, but it can augment growth. It can give a little bit of cushioning. It can give a little bit of buffer. And a lot of this is very nuanced. And to ensure that this is understood well by an ecosystem takes time. So it took maybe 5, 7, 10 years for this evangelization to happen. Now I think we're at a point where there's a high level of awareness. I mean, we've funded a couple of hundred founders, and I'm sure other players have done the same. So there are at least 750 to 1,000 founders in India who've tasted the product over time, and not all the stories have been great. So there have been situations where companies have gone down. We've got some here, and there are companies which have gone extremely well. So education, I think, is the first area which needed work, which I think is in a good place. The second is, in fact, I was just finishing a call today morning, and one of the questions from an offshore LP was, is the product something that works in good times or bad times? Right? And it's a very logical question to ask. And my answer is both, but the drivers are different. Right? In 2021, we had a similar level of, we do about $200 million a year of funding. But the reason was, nobody thought they're going to wait 18 months to raise the next round. Right? Everybody was like, okay, I'm going to raise the next round in 6 months or 9 months. Can I be the biggest, best version of myself in that time? Needs an investment into your working capital, investment into brand, investment into people, and can you just show, can you pound harder, right? Can you hit the ground harder? The last 3 years have been kind of the opposite, right? You may be ready, the market's not ready. Both you and the market are ready, but the price is not attractive. So there are a lot of reasons why founders just want that extra bit of time. And sometimes it translates to showing a little bit of traction, which is useful, or getting, if you're a B2B business, getting that one extra logo that makes the point a bit harder, or getting the right people on board, investing in a particular campaign which allows you to build the brand and showcase those efforts, or just getting revenues and unit economics in place. Some of these need to be shown with vintage. It's not just about getting 1 month of, okay, I've got a 10 crore monthly run revenue. It's not recurring, and it's not a run rate necessarily. And it's not enough. It can be a flash in the pan. Can you show that for 6 months? Then you're valued differently. Are you showing a good CM3, the contribution margin level? Are you making money or not? So from a venture perspective, what is exciting is when there's less food, people get leaner in some sense, right? So the capital flows, by the way, the good companies have had no issue with access to capital. I think they continue to get access to capital. Price may be a little bit compressed, but even then we've seen companies get the price that they want as well. There has been a clear differential in a good company versus an average company. And 21 was a time when the rising tide lifts all boats. That differential was not there. So what I'm excited about is there's a clear quality differential. The second thing is, from a venture debt perspective, we can't be in binary situations. So why have we not done a lot in here? We've done a few deals where, for example, voice is a space that we like, visual imaging, anything that is around creation that we like. But there are a lot of companies where it's tough to predict whether they will last 6 months. They will continue to be valuable in 12 months. So we didn't do any real money gaming. We didn't do areas which are fairly binary. Same way we can't do pre-PMF situations, right? What might excite a few of my colleagues here or my peers here, the pre-PMF, you get the right founder and then you ride the wave. It's a great venture equity return. Not the place for me to be. So having a portfolio which is a couple of hundred companies, there's a natural heft in terms of just follow-ons in those companies. Adding 20, 30 attractive companies when 1,000 companies get funded in India every year allows for an organic growth. Better education in the market as to when it doesn't work. I think that is another big learning. Not all companies should take debt. Even within many of the common portfolios, there are situations where we say, don't take debt right now. There's one company we were just talking about before this, which we just funded this week. We've been talking to the company for 2 years. And the timing was right this week. After 2 years of conversation, it's a growth stage company, highly exciting tech product company, and it's a global business. And some of these need the right timing to fall into place. It's not just about the company being good, founders great. The timing has to be good as well for the product. And there are enough anecdotes on that at this point of time.
Got it. So a couple of takeaways on what concerns I'm taking away is no pre-PMF and no binary risk. And of course, what you like, what excites is the inflection point and a bunch of other metrics that you look at. Great. So KGS, coming back to Nexus. Right since inception, you've been straddling the India-US corridor, and now we've seen a lot of our peers in the VC community trying to focus on that, especially given the AI opportunity. What are some of the lessons that you've learned during this journey? If you could share it with everybody here, that'll be helpful.
Yeah, I think the biggest strength for us was the teams, right? Which is a strong team available in India, similarly a strong team available in the US. Because of that and the way we were, able to work with the founders in both these ecosystems, everybody felt that we are local. So, and then when one wants to cross to the other side, it was easy for us to connect. And at Nexus, our philosophy is basically that the whole partnership is available for the founders. So it's not that just one person does the deal and only he is available. So the founder can choose, or founder can, depending on what at that time whom he wants, or particular thing what they want from a particular person. They can, all of us are kind of available for the entire founder ecosystem. So those things actually really helped. And then I think we were a little bit fortunate to understand that a strength of founders who are actually starting something here in a garage, and we felt that that guy and a couple of guys together are good, and they can turn out to be the best and bring out something which is valuable for global operations. And they actually moved from India to the other side and built globally recognized companies. And similarly in the US, we are seeing local founders now, trying to start something and they want to leverage India for whatever they have, and we're seeing that, and then that's kind of happening. So I would say the team plays a very important role in that particular thing, and unfortunately for us, the team has been together for longer time.
So building a local team there. Number one, opening up India market for even a native US founder. These are two key takeaways I'm seeing. Tarun, coming back to you, what we are seeing is on the data side, a lot of cross-border investments from the homegrown Indian VC funds. Do you see it at Matrix as well, at Z47 as well? And what explains it?
Yeah, I think so. We've also done quite a few. I think we started late relative to some of our peers, but I think starting 2018, we've actually doubled down quite a bit over there. I would say I think there are two themes. The first theme is Indian founders that we are backing at seed Series A and are basically moving to the Valley much faster or to the US much faster than they used to. So we've backed companies where we funded them early, but for the first 5 or 7 years, they actually just built for the US from India. Freshworks is a great example, and so many other companies that, where in Girish, for example, moved actually closer to IPO, right? Didn't move that early. But today, I think what we're seeing is literally within, 6 months to a year after we first financed these young companies, they're actually moving to the US because I think they've all learned that building for the US from day zero is actually the right answer. It accelerates, your experiments. It allows you to grow revenue faster. All your learnings will compound, and so it's better to get there sooner than later. So I think that theme was something that we've seen and continues to play out. I think the second theme that we're all seeing, and we were talking about this offline before the panel, is I think while the next 10, 15, 20 years look very exciting for India from an AI perspective, the reality is a lot of the activity today on AI is actually still in the US. We aren't seeing as many groundbreaking or breakthrough ideas from Indian founders that are based over here. And maybe it's just exposure. Every ecosystem takes its own time to get built. I think we're in the very early stages of that. And so when we're talking to founders who are, in many cases, Indian origin founders, but they've just been based in the US for a long time, we're actually seeing better quality of ideas, and it's just osmosis. They're part of that ecosystem. We, as a VC, we need to follow our founders. And if our founders are already in the US, we need to make sure that we're putting ourselves in a situation where we can actually get access to those deals early. The second thing that has happened is now that 10, 15 of our founders have moved to the US. Right. They are part of that whole network of founders, and they are actually sending us deals actively to look at from their network. Now, I can't say, hey, I'm sitting in India, and so I won't fund a founder who's in India, who's in the US, but oh, I don't mind funding him, and then he goes to the US. So I think it's partly the market has moved us to a point where we're saying, listen, we need to build a team there. We need to make sure that we're putting up all the stuff we did do in India to help our founders succeed. We're doing the same thing in the US today. And to KG's earlier point, I think access to India market is a big deal, especially in the world of AI. Helping some of these founders build tech teams in India, engineering teams in India is a big value add. And honestly, US VCs can't help them with that. Or people who are only based in the US. So I think there is also enough of a value add that we're finding that we can do to them. But yeah, what's the right to win? For an Indian VC when it's a highly competitive deal and you got Sequoia and Benchmark and First Round and all these guys chasing it in the US, I think that all of us will have to discover as we go along.
Right. Thank you. So coming back to Ranjith, how is Chiratae exploring cross-border investments? Number one. Number two, recently your portfolio Unifor raised a Series F $250 million from NVIDIA, AMD, Snowflake. Your experience and learnings from the success of Unifor, which did that transformation to doing this as well.
Yeah, so I think Unifor is an interesting story. I mean, it was an India company. Can you guys hear me? Yeah. Like I was saying, Unifor is an interesting story because it was a company based out of India. I mean, when I met Umesh, he was out of IIT Chennai in the RTBI center trying to do something in speech and voice, which is it's interesting. I'm talking 2013, 2014, and we had built that initial thesis saying that speech is the very natural form of communication, and that is what will scale, right? And it's really played out well for us. But it's not without. I mean, from the outside, it seems like it's just gone to the roof in terms of what they're trying to do. But really, it's a company that's gone through multiple pivots. I mean, it was a fully a license-based platform when we invested. Was doing about 15 crores in revenue that the year that we invested. We actually, that year we asked them to shut it down, re-architect the product to build a multi-tenanted SaaS because that's we were seeing that shift happening. And then one of the founders shifted to Singapore to look at Southeast Asia market, and this is a learning that like what Tarun was saying, right? I mean, all of them India customers, and then we said, okay, we will go to Southeast Asia. It was around Series A that Umesh actually shifted to the US. So while we did the seed investment, right? And so that has significantly changed. Like he's saying today, when we invest, even seed stage companies are thinking, or all US companies in the first place, if you're thinking about AI and stuff like that. So they're looking to shift there much faster, right? And that's a very clear learning from a Unifor standpoint. So it was much later that Umesh moved and built that piece out. And it's a learning process for founders who go from here in terms of just especially for people who have not lived there or not been there. When you shift there, that ecosystem is very different. How do you, your first hires in the US will go through a, churn by themselves. I mean, Unifor had to fire a bunch of folks that they had hired early on, especially around sales, because the salespeople in the US are very sophisticated. They can talk you into almost anything, and then it's only a year later you figure out that, there's a big gap between what they speak and what they actually deliver. So I think those are the learning curves that people have gone through. And today there is a lot more better understanding of that. And for us, we are a, India-focused fund. So, I mean, we do not have the bandwidth to go look into the US from a foreign investment standpoint, unlike, some of these folks here who have the bandwidth there. Right, so our focus is really how do we build an ecosystem that can help founders that go from here to there. And in the last 15 years, we've built a small ecosystem of founders, advisors who have those networks and been there in the system for some time to help the early transition, especially around seed stage, for founders who kind of make that shift and then grow from there, as against to trying to do something here, because the real challenge is for all of us to figure out is like what Tarun was saying, is a company there, why would they raise money from Chiratae Ventures when you have access to about 1,500 funds that are there, right? And then if they're coming to us, then the real question is why? And so that's really something that we
So just to draw the lessons from this, Tarun is saying earlier the better, at least the signals between a Girish Mathrubootham versus the more recent founders, they're going sooner, versus what's played out successfully in your portfolio. Let's say Unifor, maybe a Cloud Cherry. I don't know when Vinod made that transition. Pixis, which is in your portfolio, they also had enough customers, enough PMF here, and then went to the US. So is it earlier the better, or post PMF in India and then go there?
Absolutely. The shift I'm saying is those companies took too long to go, whether it is Cloud Cherry, Vinod, or
Right.
Automation, something like that. Because see, I mean, when you build a product for India and Southeast Asia, greater India markets, or whatever you want to call them, right? The product direction that you take and all that will be very different when you're going to the US. So there's no point in trying to build something here when majority of the market is there, and then trying to re-architect at that point in time.
So you'll have to build from scratch, understand the customer requirement from scratch. So sooner the better.
Absolutely.
That's interesting. Neha, so how would you look at this trend, especially, I think Tarun, the last point that he mentioned, what's our right to win for investment that's originally in the US, incorporated, et cetera, et cetera. Do you want your funds to focus on Indian opportunities, play to their strength, or experiment a bit? What's your view?
So see, there is a clear trend and there's a clear segment to focus on, which is India for the world, right? And we're seeing that. So most of our GPs, whether it's private equity or VC, is focusing on this segment, and there's always profits to be made, money to be made, investments to be scaled up in this segment. We don't, I think if your focus is just this, then I think the question is, okay, then why would somebody want to back a fund in India? What is the right to win, right, for that fund? Vis-a-vis, then why not people play the US market or invest in the US funds who have more experience, who've got better who've got better connections there and will be able to play that trend better. Of course, there are reasons for that, and therefore we're seeing international capital flow into this segment. But this cannot be the only thesis, or this should not be the only thesis. That's one. I think what we also like to see with our managers is, given that we're IFC, we do direct and indirect investments. We also like managers who go a little bit off the beaten track, right? Today, everybody is talking about this trend. So honestly, if I meet 5 managers in a week, pretty much everybody is talking about this trend. It is very difficult for me as an LP to say, okay, so what's your right to win? Everybody believes we have the right connections, we have the right advisors. It's the same playbook. And honestly, believe me, it is the same playbook. There may be a little bit of nuance, there may be a little bit of difference, but it is not significantly different. So I think either managers do a better job of communicating that, or there is really something more to it. One of the key things that we've seen people do, which is slightly off the beaten track, is the whole South-South connection, right? Like what Unifor Ranjith was talking about, that they're saying, okay, we're not just building it for India, but also Southeast Asia, but also maybe the Middle East. We're focusing on maybe, we're seeing companies come out of, so we've got a couple of very interesting fund managers and direct investments in countries like Poland and Romania. And we're seeing some very interesting tech companies. UiPath is a very well-known one which came out of Romania. So I think doing a little bit more homework, being a little bit more connected in some of those markets also helps. And we do that. We do that on our direct side as well, where we try to sort of leverage the knowledge that we have, the experience that we have from there, and see how they can partner with companies in India, or they can do something. They can sort of collaborate more.
You know, if I can just add to this, I mean, see, we are talking this in the context of AI, SaaS, where naturally the largest markets are in the US. So you're always thinking how we go US first, right? But I mean, if you look at our portfolio, there are some companies which have built significant scale in India and then decided to go out, not in SaaS but in consumer. Think about a FirstCry, think about a Lenskart, and all of those. It's a very different proposition. They're building scale first in India and then thinking about going outside. So that is also another phenomena. But um, slightly the trajectory is different. I mean, you build that muscle in India, you build that, the price advantage and everything else that you have that India can offer, and then take it to the rest of the world. Think about a Miko. I mean, we got examples. Ultra Human is another case we were talking about. Miko in our portfolio is doing something very similar where, it's been built here, but going outside. So I think that is also something to be, something that we track in terms about, how do we think of when we invest, how do we think about a product that can scale in India but can also go global, right?
So very interesting.
After if you have a point to make on.
Yeah, maybe just before that, I just add one point. I think we're all talking about this, but at the same time, you have to also look at the exit. Right? There are a lot of companies who have actually moved to the US and stuck in US because the market size is not good enough for them to be listed, and they want to come back in India, and then there is too much of complexities on that side. So it's very important to understand that just because everybody is going, let me also go. That should not be the case. But at the same time, you have to know where you are, what you are building, and where the real market is going to be, and where you are going to grow, and then based on that, you take a decision and have some flexibility. Is what I would say.
Yeah, just thinking about what Ranjith said, and I think it's a very important point. It's not just the tech businesses, right? You have some consumer businesses like you have Mokobara, Ultra Human, or a few others which have a good product, and then they go outside India to sell. And we had Mensa brands as well. The issue there, which founders realize a little later, is coming to the point of exits, is how do they get valued? Is it an India business? Is it an America sales business? So if you then talk to a large investor, the multiples are different. The drivers of success are different. It's the same company. So while currency helps, especially if you're a consumer product and you're exporting, whether you're selling a service product or a consumer brand, ultimately, when you are getting valued and you are creating an outcome, is it multi-geographical kind of a business, or is it an India business selling? So there's a lot of labels that come, and we don't have playbooks for this. We don't have precedents where, okay, this is already established, and this is going to be the resultant multiple, and that creates a bit of friction as well. Unless the margins hold and the product, the brand lure is so strong that you are going well past that question, which is rare. So I was just thinking about the nuance when the conversation happening. For some of the business, very logical. If you're building for the US market or your resource ability is going to be large in the US, in the AI world, I think it's a given. But if you're anything else and you want to sell outside India, I think that's a very complicated question to answer.
It's a tricky one. I can clearly see two aspects playing out, right? Like one, the initial cost arbitrage or value arbitrage that we took benefit of the fresh works being built in India versus today. I think while software arbitrage is probably shrinking, I think some of the products, Lenscard, economies of scale, Miko Robotics, any of these products, once you have economies of scale in building, I think value creation is one layer I see, and then like the other complexity in the value capture layer, which is valuations, fundraise, flipping back to India and all. Tarun seems to have a point here.
Yeah, I'll just say, while we're all trying to make generic points, I think there's nuances to each of these, right? Also, right? So, one of our portfolio companies, Moengage, they just announced a round yesterday. Now, their path has been very, very unique. So, they actually started building a software AI marketing tech stack for India. They captured a lot of customers in India. They realized that customers in Southeast Asia actually had similar needs, maybe with some differences. They actually then went to Southeast Asia. Each of these two businesses became sizable. Then they expanded to Middle East and Europe. Those businesses started becoming sizable. Now, for the last 3 years, they are selling into the US. And because what they've also understood is that the customer archetype and what they desire in terms of the broad space in which they play, which is customer engagement, is not that different between a consumer brand sitting in Indonesia versus the US. And that team and the entire founding team continues to be in India, plans to be in India, has no need to go to the US. So I think it's also in some cases, do you really need to do that to be closer to your customer? If you've already understood your customer well enough and their needs well enough and are able to solve it from here, they're also, by the way, in the process of flipping their domicile from US to India, and because they will list in India, at some point. But yeah, they've been able to build a very successful 100 million plus revenue top line company, growing 100% year on year in the US without ever, having anyone in from the team in the US. They're all doing it from India.
Interesting. A lot of learnings here. So Tarun, back to you on DVC platform. What's been the thinking of starting DVC, and how do you see the synergies between Z47 and DVC currently? It's quickly become one of the very active early stage. I was just looking at the data, and it's among the top 5 for the year in terms of number of deals. Would love to hear your thoughts.
Yeah, so DVC started, a lot of our peers were building their own seed programs, and I want to say it wasn't out of FOMO, but partly it was. But I think 2-3 things happened in the ecosystem at that time. We went and asked ourselves, what was the evolution of seed investing the world over? And it started with, sort of individual angels, and then YC came, and then YC quickly became like the go-to place to raise seed funding. And then it went into founder angels and super angels, doing these deals. And then it went into this whole scout program-ish kind of equivalent where, you give money to founders to invest on your behalf to identify opportunities. And then it came the era of solo angels like Elad Gil and a bunch of these solo GPs, right? And we said, listen, India will at some point follow that same path, right? Where today it's seeming like there are certain, seed programs, but the reality is that over time, access to the best and highest quality young entrepreneurs, there will be a group of superstar founder angels that will get disproportionate access to those deals before anyone. Like, for example, somebody at Razorpay, if they are starting up, they are not going to talk to a VC before they go and speak to the founders of Razorpay. They actually are going to first go and talk to the founders, get blessings on the idea, get blessing on starting up, maybe raise some funding from them, right? And that can be replicated across a cred, take every company which has high entrepreneurial talent, and you will basically see that that same theme is playing out. Second is, a lot of these founders have become really rich. They can write 100K, 200K, $1 million checks themselves. They don't need a VC to be participating in that round. And when a few of them get together, they can very well do that, initial $1 million seed round. And then the third thing is, a lot of founder angels told us this, that listen, we don't want to take these deals to VCs because you guys just screw up the cap table. You all come in with sharp elbows. You all tell us, hey, I need 10% ownership to begin with. You all increase the valuation. Suddenly the company that wanted to raise $500,000 is now raising $3 million. I mean, why will I mess up my deal, right? And so we took all this feedback and we said, listen, you know what, either we can compete with these guys or we can actually partner with these guys. And so we actually put together a founder angel group of about, I think it's about 50 odd well-respected founders that, we know and respect. And we've basically said DVC will be a blind pool of capital. Anytime one of the 50 of you is putting personal money behind something, we will just do a blind follow. Right? Now, it's a simple, we put in between 30 to 50K in that round. There are 2 or 3 nuances though, how it's different from a scout program. There is no analyst in our team that is deciding whether that scout should be making the investment. These founders are superstars in their own right. They don't want to be told by an analyst at a VC firm, ki isme dalo, isme mat dalo. Right? They're like, boss, I know better than you. Second is, I think they don't want to mess up the deal dynamic. They don't want somebody to come and say, hey, but I need so much ownership. Third is, they're all very busy running their own companies. And so the value add we can give to them is we can very rapidly syndicate. So let's say Harshal and Shashank at a Razorpay were only doing fintech deals, but a Revant was doing, consumer deals. Today, all these guys are getting cross a sector deal access. And they all respect each other. So they said, oh, if Harshal is doing something in fintech, just count me in for some amount because I don't need to, he knows better than me. So I think that community flavor has worked really well. The second thing is, like I said, we don't tell them what to do. We just follow their own conviction. And by the way, we are not giving them money to invest. They are putting their own, their skin in the game. So there's very little, this thing of incentives and all that because they would have put that check with or without me. And then the third thing is we're giving them access to our operating team. Just the way we would help our own portfolio companies with later stage financing, with, portfolio support, with access to, talent. all of these things, we are now giving them access to any DVC company. And I think that value prop helps, and then the rapid syndication amongst the angels helps. So very often, like I've spoken to, say, a Ramakant. Ramakant's like, listen, I can put 100K, but this guy needs 500K. I don't have the time to pick up the phone and speak to 5 other founders and say, will you put some money to this? Because then I need to explain the idea to all of them. I need to explain to them what my thesis is. Here, I just tell DVC, I'm putting in 100K. Within 48 hours, you get the rest of the round syndicated. And that's a big value add. So I think that was the thought. It's been working, I would say, pretty well so far. It's early days for the program, so we'll see where it ends up. But so far, it's looking good. And the other good thing is, because it's a blind pool of capital, the typical risk with a lot of seed programs that VCs do is that there is a signaling issue. If I don't follow on and lean into the company in later stage rounds, there is a big negative signal attached to it. That was the other thing we tried to solve with DVC, where we said it's a blind pool. Just the way every other VC will have access to the portfolio, Z47 will also have access to the portfolio. And so far, actually, out of 30 odd companies that have raised follow-on rounds, or DVC companies that have raised follow-ons, we've only done 2. 28 have been funded by other VCs, including several people on this panel. And so it's actually a completely open program, and we've structured it that way.
Very interesting, very new and fresh. Great. Do you want to open up for questions now? I have a couple of more questions, but if the audience is in the mood for questions, feel free. Anybody? Sure. So yeah, so one question. Maybe one question I have on deep tech, and then we'll come to you. We've been speaking about deep tech, and one question we have is, how deep is deep tech as a market, right? Can a standalone fund be successful if it's focusing only on deep tech? Your thoughts on that? Maybe Neha, to start with, horizontal funds versus specialized funds, and then the rest of the panel can give you views on the same as well.
So I think our general experience, and I think for a lot of LPs as well, because we've done a lot of investments in India, sector funds or narrower strategy funds were funds that we were keeping away from for about a decade or so. The last sector fund we did in India, for example, was in 2011. And then till about 2021 or 22, we didn't touch sector funds because our experience was quite bad. I think it was mixed because of a couple of reasons. One, the sectors that we backed were probably not the best sectors to back. And those sectors actually didn't do well, and therefore the funds in those sectors didn't do well. The second issue was, when the sectors were not doing as well, the teams didn't have the opportunity to look at anything else because the strategy was so narrow, and therefore they had to either do bad deals or not do anything, and therefore the money was not deployed. Having said that, in the last 3 years, we've revisited the whole strategy, because sector funds, if you look at the overall market, and that was one thing that I did when I joined IFC, we mapped the whole market, and we saw that it's not that all sector funds are not done well. There were pockets and certain sector funds which had actually done quite well and outperformed the generalist funds in those sectors. So we said, okay, maybe the way to approach this is different. And therefore, we have now revisited our strategy. We've actually backed a couple of funds, one in the healthcare sector, something in the financial services. Now, coming back to deep tech, I think there is merit. We like the segment. The only thing is, when we look at deep tech, we look at it globally. And we say deep tech only in India is a very narrow pool for us. So therefore, we've sort of compared it to the other global funds, which are doing only deep tech. Unfortunately, some of the funds, because we only do 1 or 2 such funds, right, a year. We don't do like 5 deep tech funds a year. So we're doing only 1 deep tech fund a year. And therefore, when you compare them with some of the global funds, we thought that the value proposition of the global funds was a little bit better, given that they were global in nature. A lot of the opportunity was actually sitting in the US, in the developed markets, and therefore, managers who could access that was probably a little bit better. But on a standalone basis, if I were to remove that consideration, because we are a global investor and we have that choice, so to speak, I think there are some very interesting deep tech funds in India which we are watching right now.
Got it. Ranjith, Tarun, Ranjith, you mentioned you have a very high focus on deep tech as well, right? Like standalone fund. Given
no, it's not
especially exits is a question again, right? Like,
So I think, we have a higher focus on this fund compared to the rest of the funds. I think that's the way to really think about this. If you look at our allocation, I think we still will deploy maybe 10-12% of the fund into deep tech, right? Because deep tech, I mean, it's a very broad segment. There are multiple sectors within deep tech and so on and so forth. So I think it's important to be careful as to what we're doing here, because our funds are 10-year funds, gestation periods are longer in deep tech, and our learning has been that, one, the domestic market for any of these kind of technologies is very little, and so you'll have to go outside, and that's not easy. And two, supply chain of capital for deep tech in India has been low traditionally, right? And it's changed in the last few years, and I think that, and within certain sectors, again, I mean, like I said, there is significant push from the government side. In the morning we were speaking about the RDI fund, and I think that's going to make a huge difference, right? And within sectors, space, for example, there's significant investment that's gone in the last few years into space, and India has indigenous space tech, so you can actually look for people who understand the space really well. And back them, and so there are segments within, and I think you will see similar stuff play out in semiconductors over a few periods, because it's also important to have buyers for this technology when you build. I mean, it's easy. I mean, it's one thing to build a piece of technology and the solution, but if you do not have a market for it, that becomes it's a challenge, and I think that is shifting in India with respect to some of these sectors. So we are interested. We believe it's going to make a huge difference, especially given the geopolitics that we are seeing across the world. But it will happen in a few sectors, and it will not. I mean, it will not happen across all the sectors. So we need to be careful, especially given our fund life constraints and so on and so forth. But we continue to remain interested in space, in in energy transition, and so on and so forth. A few of those areas that I think we are definitely interested in.
Absolutely. So you're limiting your allocation to 10-12% of the fund. That's one. One interesting development is IIT Madras has asked for an expression of interest to existing VCs to partner with them to co-create and co-manage a deep tech fund, exclusively deep tech fund as well, right? We know your take on, given long gestation periods, how do you underwrite a deep tech opportunity? Or would you pass it?
It's very hard. But there's actually a role for leverage if you think about infrastructure, hardware, working capital. These are all words that you'll hear with any business which has a long gestation period and is investing into something which is significantly value accretive over a long period of time. But there is a period where you have to hold your breath. The answer actually is getting PMF for the product of funding, right? Which is, you need more patient capital. Maybe you need subsidized leverage, which is what the RDA fund is talking about from the leverage side as well. Many of us are part of the consultations around that. I think there has to be a pocket of capital which is willing to subsidize in some sense the economics to ensure that this is a sector that takes off eventually, because it's very difficult to demonstrate success in the short term in such an endeavor. If we talk about some of the companies in the space segment, or even many companies we've seen, the day before a payload has to go up, you still don't know if it's going to go up or not, right? So the binariness is literally on that day. Forget about the last 5 years before that. And the commercial usage happens 12 months later and 24 months later. If you look at the hardware side of things, in fact, that's where Silicon Valley Bank launched in the first place, which is, why do you want to spend good, valuable equity dollars on hardware? You don't need to. You can use leverage. It ranges from laptops to server farms. I mean, it can go all the way up. And today, it could be chips. Whatever the use case is, I see more value there because it's a little bit more tangible. There is an asset which can be underwritten to. It may still have a longer time period for value creation. So that piece of the puzzle is still not fully visible to me. I mean, there's a role to be played to at least take some of the pain off in the initial phase. But the takeout still has to be equity capital, possibly, or another slightly more mature debt product, which doesn't exist today. So it's work in progress at best, but it's something that we are at Alteria paying a lot of attention to and trying to see what we can do, and can we stitch together a product which makes sense for companies over a longer period of time, but it needs to be matched by a supply of capital which agrees to that.
Thank you. Any further thoughts, or let us open
I
up?
have nothing more to add on this.
Great. Let's open up the floor for questions, please, sir.
Good afternoon, everyone. I am Saket from Valuation Advisors. This is a general question. Like, with more of the global companies choosing to list in India, like LG, so, and they are getting good valuation. So how this phenomena will affect the structuring of the new startup coming up in India?
Maybe I can rephrase. I think probably what he's meaning is the global counterparts are getting exceedingly high valuations. Not necessarily in India, and like, are Indian founders going to sort of compare and ask, is that the question?
So how this will affect the structuring of new startup coming in India in a global perspective?
Sure.
Global companies are listing in India.
Okay.
So how are you going to structure the startups in India? Okay, maybe I think this is something which I actually touched upon slightly earlier, right? It's basically you have to understand what you're building, where your customers are going to be, where your revenue is going to be. Like Vinod also said, are you going to be a Indian company or a company in the US, but for doing India business alone, right? I think gone are those days where you could have listed those kind of companies in the US or elsewhere because the standalone India business may not get that kind of valuation for a US company. Or are you going to be an Indian company building for global, but then you're stuck in India, then you have other challenges. So there's a little bit of evolving, and I would say you will see based on how the business is growing, people would see this moving a little bit. And because again, it's a cyclical, right? Because we have seen, I think 5-7 years back, everybody was talking about Indian companies of overseas listing of Indian companies. Now it is the reverse of Indian listing of overseas companies. So this is cyclical. This will keep changing depending on where the capital is available, where the valuation is favorable. I would say it's very easy to say, but very, very difficult to implement. I would say keep flexibility in your structure.
I think when somebody is starting, they don't immediately think of listing, right? So first, the reason that a lot of offshore headquartered companies happened a few years ago was because the providers of early stage capital were not Indian. They were foreign funds, and they didn't want, in some case, the liability of being on the board of Indian company. And it was easier from a currency perspective if you're doing things offshore. Today, that's not the case. I think everybody here is, in a sense, an Indian fund or aimed at India. Maybe Tarun's a little bit of an exception on that, Nexus as well. But everybody's got either a plan not to be here. It's an India-focused fund. They will fund Indian companies. It's not India plus another geography or US or something like that. So I think the access to capital for Indian founders with Indian domicile is the best it's ever been. So there's no need to set up a foreign domiciled entity unless your business needs that. So it's not just a listing question, that's maybe 10 years out. And by then, who knows where the markets will be. It's today's capital question.
Hi, Shishir here. Just a very fresh question to all of you. If you all have had an anecdote where for the GPs you thought that you want to go on the other side and just be a part of a founding team when you've heard an idea, or for Neha, when you've heard a thesis from a fund manager and you said like, oh, I wish you was on the other side. If you can share a very quick anecdote, each one of you, there must be a case, or say no, there haven't been a case that something has come across like that. We don't need to shift the
What
table.
did you get most excited by the other side of the table?
Well, in my case, actually, it was spinny. So a little bit of context to that was I found Carvalho like 10, 12 years ago, which had a good outcome. And I thought Neeraj was taking on the toughest part of the problem, which is not classifieds, not, and we had another portfolio company as well, not like selling to a dealer and so on. Literally a tough problem, which is micro market, understand the seller of a car, buyer of a car, refurbish the car. Sounds easy, incredibly hard. It's a automobile question, product question, marketing question, execution question, and just the founder who had a lot of charisma building it. And that was one instance.
I think we have had situations where we have seen investors from our firm moving and becoming founders. So that we have seen very clearly, and then they were so excited about doing that.
After listening to a pitch of a founder?
No, I think I think it's basically, as you are moving towards, you realize where your, right fit and the right passion is, and then, they do that, actually.
Yeah, there are many of my colleagues who left us and started companies. So I'm assuming this is a very natural phenomena that, and some of them have failed also, by the way, and because it's one thing to listen to somebody and say, okay, this is so easy to do, and then when you start doing, you realize it's not as easy as you thought, right? But in my case, when I met Taxi for sure many years ago, I really thought it was a great idea, somebody should have cracked it. Although my team didn't think so, which is why we didn't go forward. But I was absolutely convinced that this is something that can really scale.
I think it happens all the time. I think all of us have had examples where colleagues have left and started up. But personally, for me, I think 21, 22 was definitely a phase where I thought about it multiple times, multiple ideas, not just one. Today, many of my colleagues actually have come and told me that, listen, with AI, like we are so early, and this is actually a once in a generation lifetime opportunity to actually build. Capital is available super easily. Valuations are insane. Founders are taking secondary and Series B rounds. VCs are waiting for 10 years to get any carry. So suddenly now the odds of making money are far better as a founder than they've ever been. And it's not just the money, right? It's also the excitement of actually building something when you know that there's enough capital available to help you achieve that vision. So it happens all the time.
Very, very difficult question to answer because because I've been a GP. I've been longer a GP than an LP. So I know the gory details of being a GP. And I now see everything, all kinds of GPs, right? And I hear a lot of things. It's very difficult to take a particular name but there are a lot of GPs, even in our portfolio and outside, where when I meet them and I talk to them and I feel, oh wow, this is really exceptional about them. It's very difficult to take a single name though, but many GPs who inspire me for, somebody is very good at the way they've built the team, somebody is very good at the way they've built the thesis, somebody is very good at the way they've sort of handled their company and the way promoters and founders talk about them. It's really great to see that. But no one GP that I can say, okay, this is it. Very difficult to say that. Thank you.
That was an interesting question. Thank you. Please.
Hi. A question which has multiple breakup, anyone can take it up. This is in relation to AI part, because we all talked about AI. Now, with the AI, one is, do you guys agree that there is no more an information arbitrage at all? And largely it's an execution risk. So no more idea survives. It's the execution that survives for making returns. B, as a venture capital investors, did you see the life cycle change? Because with the AI coming in, the survival of the company, the period over which you actually survive, that could have significantly reduced. That's a hypothesis I'm making. Did you guys see when you are investing any insights that you have in that aspect? And third, essentially, is did the AI eventually lead? It's only a few years now. Or your hypothesis, will it have more downside impact or upside impact for businesses to survive? Because it requires a constant adaptation. Because every other day there is something new that's coming up, and you would have invested something, and it might already have a substitute in the market. So these are three broad questions. Anyone can take it up. Thank you.
AI, please.
Since this was a topic on AI,
What was the second question? Sorry, I missed. I didn't understand.
Survival.
Life cycle. So
I think the first one is the easiest one to answer, which is it's never been about the idea. Right? So I think in India, if you, maybe otherwise also, but in India, definitely most successes, if not almost all, have been execution. It's a massively difficult market to be successful in some ways. It's also a massive market, right? So both are there. So like even the example I just gave now, like spinny example I gave, is the fifth player to come into the space, right? So there's no rocket science about the idea. Everybody knew you have to buy a car, sell a car, right? But doing it well, that's the tough part. How do you understand consumers? How do you build a product that makes sense for them? Where do you price it? What's the profit pool looking like? How do you manage a balance sheet? So there are so many things that drive success. And hence, it is not just about one, okay, I got a eureka moment and nobody else can. The next minute, 10 people are doing the same thing. So I don't think the first mover advantage has been massive. I mean, Flipkart wasn't the first to do what they did, right? And look at where they are. So at least the first question, it's not about the idea. Somebody else can take the other ones.
No, so one is, I think on the first one, maybe just adding, it's never been about, it's always been about execution, right? India is a tough market, and I think people forget today, there were dozens, if not hundreds of cab companies that were funded at the early stage. There were hundreds of food tech startups. At every stage, it's always, the idea is dime a dozen. So it's always comes down to the team and the execution. I think the second part, at least my thesis is, I don't know about the life cycle, too early to say. It sounds like disruption cycles will actually further reduce in the age of AI. But I also have a contra view to that, which is, I think the big will keep getting bigger with AI. And I think already we are seeing it play out. If you see S&P 500 returns in the last 5 years, 90% of all gains have come only from 7 companies. And the amount of capital, the amount of data that is required to make AI work for you, it's very hard for a young company to have access to any of that. So I actually think that AI will mean that the big will keep getting bigger.
If I can just add to it, it is one thing to build an AI, a product or whatever it is, right? But your moat really will come into, from an enterprise standpoint, how well you are integrated into the rest of the systems. All of those become important because you do not want to be a system which can be easily replaced, and your integrations and how well you're connecting the rest of the systems within an enterprise will also have a bearing on how well you can be replaced. So it's just not building about a product. I mean, it all comes down to execution again, and in terms of how you think about your GTM, how do you go about, getting into a customer, what kind of customers you go for, and so on and so forth.
Yeah. General, go ahead.
Yeah, hi. This is Manish. I don't know whether we have covered this topic or not, but it's all over in the media. So how US-India tariff tensions reshape the investment thesis for PE and VCs funds operating across both geographies? And the follow-up one will be, which sector are majorly impacted? Do you see any change in the timeline in terms of concluding any transaction that you guys are currently working, both on the investment side and the exit sides?
I'll just quote something that Srini from the first panel said. I've seen many Trumps come and go. Right? I'll let the peers on the panel answer this question.
Yeah, I would say that actually, because these kind of things will keep happening on the regulatory side, on the tax side. Challenges will keep happening. You will have to, even in India, e-commerce sector, if you take, when we started way back in 2010, e-commerce, there was no law. Anybody could do anything, right? And then came the B2B, B2C rules, then came marketplace rules, then came other rules on who can own how much of that, share, the sales can be of single party, two parties. So people, this all evolves. Nothing. I think the beauty of entrepreneurs and founders is basically that they understand and they keep moving based on the curveballs thrown at them. And it's not the first time. The only thing is now it is happening so fast and it is affecting everybody so deep, right? So that's why everybody is discussing about it. Otherwise, these kind of challenges will come, and I would say, would this alone affect the decision making for investing or exiting? I don't think so. But this will also be one of the decision point for all of us to evaluate while investing, as well as for example, we're talking about ultra human. They're doing a lot of sales from India to US or US to US, and then tariff would have been a big concern for Vinod to take a decision. But of course, that will be an important point. Apart from other points as well, as I would say, that's what I would say.
Yeah, I'll just add, I think the joke is, I think Donald Trump doesn't know what he's going to say tomorrow, right? So it's very hard for any of us to actually plan our lives around that. But I think there are the sector which at least we feel is most exposed is these B2B export kind of opportunities. Like we have a company in our portfolio called Captain Fresh. They're entirely now a B2B exports business. It used to be, I think 75% of the business used to be exports from India to the US. So sourcing India and selling to the US. Now the last 3 quarters, as these tariff kind of noises kept increasing, I think to KG's point, I think the beauty of founders is that they're able to very quickly navigate their way away from high risk propositions to lower risk propositions. And so he actually re-architected the business in the last 3 quarters, where today it's less than 10% of supply from India going to the US. And he's basically captured other supply markets around the world, selling to the US, and he's moved all his India supply to Middle East and Europe and all that. So I think that company's already filed for a confidential IPO and all that. So I think it's harder to navigate today. You have to be super nimble. You can't take any real long calls because, like I said, you don't know which side of the bed he's going to wake up tomorrow. And so you just need to make sure that you're trying to stay as nimble as you can and then, keep adapting. Like we had a big plan, the company had a big plan to move 100% of processing to India. And then we had to very quickly change that and say that, let's not do 100% in India, let's do a little bit Southeast Asia, let's do something in Vietnam, let's do something in Indonesia, let's do something in India. And so I think today, because it's a platform, we're able to very quickly plug and play and say, supply from India, if all of that is going to be tariffed to the US, just move it to other parts of the world. And, use other low tariff geographies to supply to the US. So some of the navigation is hard, but it just has to be done.
Yeah, uncertainty is always a challenge, right? In the short term, it's not clear as what's going to happen, and every day something new can potentially come up. And this is just not portfolio. When we go fundraising from an LP standpoint, these are questions that are raised. But having said all of that, see, at the end of the day, India is the 3rd largest startup ecosystem. So anybody who wanting to do something with startups, India is absolutely difficult to ignore. And so we will find a way. In terms of capital, it will come and it will be deployed. And from a company standpoint, we have a company, Miko, which is again completely export from here. Now we're trying to figure out whether we can do it from Vietnam, we can do it from somewhere else. So I think the water will settle in over a period, and then something else new will come. Something else will come, and then it's not the first time that it's happening. So we'll figure this out as time goes by, I guess.
Thanks, all of you. We've shot the time by 10 minutes, but thank you for patiently listening and all the wonderful questions. And thanks to the panel for a wonderful discussion on all the points.
And thank you, Hari, for leading this amazing panel. Thank you to the panelists. I think the audience will agree with me that this has been one of the most comprehensive panels that you probably have heard in the recent past on venture capital. We've, I think, spoken everything from the LP perspective to founder archetypes to global India corridors to areas of investment that are globally relevant like deep tech and AI, and I'm very interested in the practical applications of AI and generally on how to develop the VC ecosystem. So thank you so much, panelists. Please come forward for a photo op, and may I request Ms. Uma Nagarajan, partner Zenith HR, to hand them a token of appreciation. Thank you.